Have you ever wondered how accountants decide whether to record a lawsuit, a warranty, or a potential gain from winning a court case? These tricky situations fall under one major accounting topic: contingencies. In today's video, we're breaking down everything you need to know about contingencies under IFRS and ASPE: what they are, when to record them, when to disclose them, and the key differences between the two frameworks. Before we jump in, don't forget to like this video, subscribe to Canada Accounting Insights, and hit the bell icon so you never miss out on practical accounting lessons that make CPA concepts easy and clear. Let's start with the basics. A contingent transaction means that something depends on another event happening. In accounting, a contingency is an uncertain situation, one that depends on a future event we can't fully control. Under IFRS, this topic is covered by IAS 37, Provisions, Contingent Liabilities, and Contingent Assets. Under ASPE, it's Section 3290, Contingencies. Now, IFRS makes a distinction. 1. A provision is a liability of uncertain timing or amount that meets recognition criteria. 2. A contingent liability is possible, but doesn't yet meet those criteria. In other words, every provision starts as a contingency, but not every contingency becomes a provision. Now that we know what contingencies are, let's see when they actually move from being just possible to something we have to record. Under IFRS, a contingent liability becomes a provision when three conditions are met. There's a present obligation resulting from a past event. It's probable that an outflow of resources will occur. You can reliably estimate the amount. If all three are true, you record a provision. Example: a company offers a 1-year warranty on its products. Based on past experience, 5% of items will need repairs costing about $50 each. If they sold 10,000 units, the expected repair cost is $25,000. Since the company has a present obligation, the warranty promise, a probable outflow, repairs, and a reliable estimate, $25,000, it must record a provision for warranty expense. So we've established when to recognize a provision. But how do we decide if something is probable enough? That's where understanding probability under IAS 37 becomes crucial. IAS 37 defines probability ranges like this: remote, very unlikely; possible, not remote, but not probable; probable, more likely than not, greater than a 50% chance. Once an event is probable and measurable, you record it. If it's only possible, you disclose it. And if it's remote, you do nothing, unless it's a huge potential loss where professional judgment says disclosure is appropriate. Example: a grocery store is sued for $1 million after a customer slips outside. Lawyers say there's a 90% chance the store will be found liable, but for a smaller amount. That's probable, so the company records a provision for the best estimate of the loss. Now that we know when to record a provision, the next question is, how much do we record? Let's explore how IAS 37 tells us to measure those provisions. Measurement under IAS 37 depends on the situation. For a single obligation, like one lawsuit, record the most likely outcome. For a large population of items, like warranties, use the expected value, the weighted average of all possible outcomes. If there's a continuous range and all outcomes are equally likely, use the midpoint of the range. Example 1. Single obligation. A tech company faces an 80% chance of losing a lawsuit, with the most likely payout being $350,000. Record $350,000 as a provision. Example 2. Large population. A company estimates a 70% chance of no defects, 28% chance of minor repairs costing $500,000, and 2% chance of replacements costing $10 million. Expected value equals $340,000. Record $340,000 as a warranty provision. Once the provision is recognized and measured, our job isn't done. IFRS also requires transparent disclosure. Let's see what exactly needs to be shown in the notes. When you recognize a provision, IFRS requires disclosure of the nature and timing of the obligation, the uncertainties involved, any expected reimbursements, changes in the carrying amount during the year. If the liability doesn't meet recognition criteria, meaning it's only possible or not measurable, you disclose it in the notes. If the risk is remote, you don't disclose it at all. Example: a company is sued for $2 million but only has a 35% chance of losing. That's possible, so it's disclosed, not recorded. If the chance were remote, like a nuisance lawsuit with no merit, nothing is recorded or disclosed. That covers potential losses. But what happens when the situation involves a potential gain instead? Let's flip the scenario and talk about contingent assets. A contingent asset is a possible gain. For example, a company suing another party and expecting to win. Under IAS 37, contingent assets cannot be recognized unless the inflow of benefits is virtually certain. However, if it's probable, disclosure is allowed. Example: a company sues a competitor and has a 75% chance of winning $2 million. That's probable, disclose only. If the court already ruled in the company's favor and it's only waiting for the final amount, that's virtually certain. Record the asset. Now that we've seen both sides, liabilities and assets, let's compare how IFRS and ASPE treat these contingencies differently. Here's where things get interesting. While both frameworks share the same goal, to represent uncertainty faithfully, they use different language and thresholds. 1. Terminology. IFRS uses provision, contingent liability, contingent asset. ASPE uses contingent loss and contingent gain. 2. Recognition threshold. IFRS uses probable, more than 50%. ASPE, likely, higher than probable. 3. Measurement. IFRS uses best estimate or expected value. ASPE, most likely amount. If range is equal, take the minimum. 4. Disclosure trigger. IFRS. Possible. ASPE. Likely, but amount not estimable or outcome undeterminable. 5. Contingent gains. IFRS. Disclose if probable. Recognize if virtually certain. ASPE. Recognize only if 100% certain. Disclose if likely. Example: a software company faces an 80% chance of losing a patent lawsuit. Possible settlement: $200,000, 30%, $350,000, 50%, $500,000, 20%. Under IFRS, it records $350,000, most likely outcome. Under ASPE, it also records $350,000, but if all outcomes were equally likely, it would record the minimum amount, $200,000, and disclose the rest. So as you can see, IFRS is slightly more flexible. It recognizes more provisions, and earlier than ASPE does. Let's wrap it all up with a quick summary. Let's quickly recap what we've learned. IFRS distinguishes between provisions and contingent liabilities. Record a provision when there's a present obligation, a probable outflow, and a reliable estimate. For contingent assets, recognize only if virtually certain. Disclose if probable. ASPE uses likely instead of probable, has higher thresholds, and records fewer contingencies overall. Measurement under IFRS often uses expected value. ASPE prefers the most likely amount. And that brings us to the end. That's it for today's video on contingencies, IFRS versus ASPE. If this helped clarify the difference between provisions, contingent liabilities, and contingent assets, make sure to give this video a thumbs up, subscribe to Canada Accounting Insights, and share it with your study group and colleagues. Thanks for watching, and see you in the next video.